Hey everybody, Preston Brent here with our weekly roundup. This is for the trading week ending DC1, that's December 1st, 2017. So we rounded out the month of November and now we're floating into the month of December. So far this year we're up a fairly strong amount. Now history shows and the stats show that over the past 30 to 50 years, on average, the month of December moves up about 2.5% of the time. So that's the mean gain for the month of December from where we go in to where we end. And this has happened 80% of the time, every time the markets are up at this point in time greater than 10%, which is where we are right now. Does that mean this month is going to be like that? Well, the statistics would seem to indicate that, but of course, you know how that always works out. But we've got a lot of momentum behind us. This year, I have been saying all year long, we want to buy the dip. Now, I define the dip as less than 5%, a pullback less than 10%, a correction between 10 and 20%, and then, of course, a bear market greater than 20%. I have been on the buy the dip bandwagon all year long, no matter what logic would dictate, and getting into the argument of are we overvalued, richly valued, low volatility, on and on and on it goes. And you could turn on any TV show and you can hear everybody saying this and getting into the argument. And then you end up just sitting on the sidelines while the markets go higher, or worse yet, like many of my buddies trying to short this market, and you end up on the short end of the stick, no pun intended. So we're still in a bullish mode. I'm still in a buy the dip, even with this crazy last week that we just had. I mean, we saw Flynn get indicted in the markets. The Dow, I think, moved over 400 points in less than a minute from high to low. And then if you were to just look at close only bars, you wouldn't even know anything happened on Friday. But outside of that, we've seen Bitcoin, which I'll talk about in just a second, has boomed over 11,000 and pulled back a little bit. We've got battles with the Consumer Finance Protection Bureau. We've seen Powell come in. We call him Power Ranger Powell, the new Fed governor, taking over in February, going to replace our own very own special Aunt B. That would be Janet Yellen. Meanwhile, we've seen short interest go up a little bit in the New York Stock Exchange and in NASDAQ. NASDAQ, its short interest rose over 2.8%. NASDAQ, or NYSE, up about maybe 1.4%. So we're seeing some really interesting action here as we get ready to go into the end of the year. We're seeing that the market is all about the tax package right now. As it moves forward, it seems like the markets are reacting to everything that comes off the headline news number. And according to most analysts, if the tax package does go through for the corporate rates going down to 20%, we'll see the earnings per share of the S&P go up another $10. Now, remember, most analysts had forecasted earnings per share of 2018 of $141. But with this tax package coming through, they would bump it up to $151. So we're seeing the buy on the rumor, right, where we've seen this big lift in the markets really since August, middle of August, going into October timeframe. We've seen a huge move in the markets. And given the potential existential risk of North Korea in this kind of, the market's got this Alfred E. Newman, me worry kind of attitude. Even with the missile test that they just recently did, which was the biggest missile test they've ever done as far as the strength of the ICBM they fired off. The markets in the Dow crossed 24K a few days later. Even the South Korean markets and Japanese markets moved up a little bit after a couple of days. So the markets are just discounting this threat of nuclear annihilation in the north and containment or lack thereof in South Korea and southern China. So it really is amazing to me. Just understand that if there is a nuclear confrontation or any kind of fisticuffs break out between North and South and Western countries like the US and Japan, South Korea controls about 17% of the world's semiconductor sales and over 64% of memory chips and about 10% of automotive parts, which most people don't realize. So the global supply chain in this whole area will come shut down in a heartbeat. Right now, Stratfor, which is probably one of the best worldwide estimate or consulting firms that does analysis of country by country and defense posture and all that kind of stuff, gives the threat of a confrontation at 20%. So that's 1 out of 5. Clearly, the markets haven't really even thought about forecasting that in. So that's kind of where we stand right now. Now, one thing that you guys are missing out on, or a number of you have, we've had a ton of people sign up last week. This week's going to be the last opportunity that I'm taking the discount away. We've done over, and I'm talking about our Option Master series. We've done over 10 videos already on risk management. We probably have another 10 to go. We're talking about trading plan development, portfolio allocation, risk of ruin, and then that really least known but probably accounts for the most component of risk management's position sizing. All of these things are covered. Hedging techniques, dynamic versus strategic hedging, whether you got a portfolio margin account and what you can do versus a non-portfolio margin account. Many people confuse portfolio margin with regular margin, but unless you've got over 6 figures and you've directly asked your firm to get a portfolio margin account, and with Thinkorswim, they'll send you a test. And I think with TOS, you need at least 125K to get a PM account. You got to ask for it. They send you a test and you got to pass it. With interactive brokers, I think it's 100K, and others may vary. But we go over hedging techniques on both of them. There are certain strategies that play to the strengths of portfolio margin and others that don't. And then we get into our master series, we get into charting. A lot of detail on charting, because if you can't determine your bias, even if it's a neutral bias, then you're going to have problems. We look at the fractal nature of the chartings and which time frames seem to make the most sense. We look at option strategies, all the various option strategies. We compare them with the types that are high touch versus low touch, looking at adjustments, or do you need to do adjustments on certain strategies? And then we compare those across both portfolio margin and non-portfolio margin accounts. Our Option Master series is probably going to run through March of next year. So there'll be hundreds of videos. Each video is cut down to about 10 to 20 minutes of key topic points. So if you miss out on this and you don't sign up over the next week, I'm taking the discount away and the price is probably going to double. So I would highly encourage you guys to do it. And you could watch it anytime, any replay if you miss these videos. We do them every Thursday night at 8 o'clock p.m. New York City time, and then they're recorded for those of you to watch it if you're resource constrained, time zone constrained, or whatever. So I've got that offer on this email. Now, getting back to the markets, the tax package everybody's watching for this weekend. We get word last night into the morning hours. They passed the Senate version, so now they got to go into a conference committee and negotiate all the little picadillos to get a final resolution where they can vote on and get it on Trump's desk to sign before the end of the year. That's the game plan right now. We're also looking at if they get a tax package through. Then for our members, we had here are the stocks to buy if Brexit votes yes versus vote no. We played those wonderfully. We had the stocks to buy if Clinton won versus Trump. We played those perfectly. And now we've got this binary event on the tax package. Now, keep in mind, unlike the presidential election, which was a total surprise with Trump winning and we saw the markets react, we were able to react to it fairly quickly because we knew which stocks were going to go strong and which were going to go weaker as a result of Trump winning versus Clinton. Same thing with the tax package, although with the tax package, we're seeing a lot of front running. And by the time it gets through, we may even have a buy the rumor, sell the fact kind of thing, or maybe just a dip a little bit. But right behind this tax package is going to be infrastructure spending. It looks like the administration, the Trump administration, whether you agree with them or not, we're here to make money in the markets and react to what this administration is going to do. I think at the tail end of 2017 and in 2018, we're going to pay more attention to fiscal policies versus monetary. For the past 7 years, it's all been about monetary policy with Yellen and Bernanke, with all the interest rate cuts and then the hikes and the stimulus and the QE 1, 2s, and 3s and ... that kind of thing. But I think in 2018, we're going to see fiscal policy come into play. Now, we could jump back into some monetary policy if Power Ranger Powell, our new Fed chair, starting in February, is going to be forced to raise rates. In fact, he came out and said, if the government starts to do some of these policies sooner rather than later, and they're successful in these, we may have to reevaluate our interest rate hike. Keep in mind the markets have only priced in 1, maybe 2 at the outside chance rate hikes next year. But Powell is on record as saying they may have to do more depending on where inflation sits. Right now, the yield curve suggests inflation is fairly low. Okay. The other thing that we're seeing run up is Bitcoin. As I mentioned earlier, in fact, the CME is going to start offering futures on Bitcoin coming up very soon. Their margins are going to not be like the typical futures margins where you only have to put down 5% of the value of the futures contract. In Bitcoin, they're probably going to do 35% of the spot cash of Bitcoin. So if, let's say, it's 10,000 for all practical purposes, you're going to have to come up with 3,500, which is still a lot less, but you're going to have that in cash to trade the futures contract on that. And we're also seeing big investment houses like Goldman and Citi jumping on board along with hedge funds coming into Bitcoin. We're seeing over the holiday weekend, Coinbase, which is the largest cryptocurrency exchange here in the US, they surpassed 10 million accounts this year. And over the Thanksgiving holiday weekend here in the US, they added, just in that 4-day period alone, 100,000 accounts. So exchanges and trading houses are reporting 5 to 10 times last year's trading volume, mostly driven, and I'll underline this, by institutions. So as this starts to come on strong, we're going to see a lot new development growth in Bitcoin in 2018. And there'll be more to come in our membership group on what and ways that we can play this. And besides all of this, low inflation, we've got, oh my gosh, we've got clearly low interest rates, low inflation, global growth is just synchronized. So that's why the markets, I've been this buy the dip all year long. Now, good things always come to an end in the financial markets. What I've got on the screen here, finally I'll get to my screen, guys. I know you see a lot of gobbledygook on the screen here, but let me just take some of it off here and show you just the Fibonacci nodes. You can see the key area in Fib. Okay, and let me just swing it back a little bit more just so that you guys can really see in here. Now, when you look at this, when you define a fib node, the most important thing you can do in the definition of that fib node is define the ranges, because that range, if you pick wrong ranges, then all of your fibs by definition are going to be wrong and meaningless. If you pick the right ones, then they're going to make a lot more sense. So in going to a weekly chart up here, as you can see, what I did was I defined a fib node at 2134. That was the highs made in the summer months of 2015. Okay, and then I defined the lows on this fib node back here at 1802 in February 2016 when the markets really cratered. And since then, we have not looked back. That is a valid fib definition of a high and a low. And as you've noted, we're now into nothing but extension territory, and they're still valid. And you can see where they've served as support or resistance, like resistance and then support there, support here like this. And the next big market meltdown, we're going to come back and revisit some of these guys on the way back down. And it's just the nature of the markets, right? So we can expect some of that as we continue to blast higher. So I wanted to show you how these fib nodes were set up. And look at the RSI. On a weekly chart, we're over 82.83. I mean, just amazing. You know, I mean, it's just amazing. So, and there is no divergences here, none at all. We haven't had a divergence really since February 2016. That was the last time. I mean, you could see leading up to that big debacle, right? Right here, all of this divergence where we were just going lower and lower and lower here as we were moving higher and higher and higher here. And then finally we gave it all up and we worked it out, and then boom, we're off to the races. And then every move higher, I mean, I could almost draw a trend line like this. Once we break this and go to the downside, all bets are off, okay? I don't think that's going to happen right now. My forecast for the markets, for our members, I'll go through that with you guys this Sunday evening. But let's just say that the markets are not yet frothy. I still project more upside movement in the financial markets, as I have been. And we're going to get through some of these Trump things. But you can see here the volume over price, this huge amount of volume. And this volume is based on time frame. And as we go higher and higher, the volume has held steady until we've gotten up to around the 2550 area, right? And now we've extended it up to almost 2650. We're at 2631.25 for the all-time highs, right? So we're going to find ourselves kind of stuck here just a bit. Now, but I do believe we can make some higher highs. If I take it down to a daily chart, right? and we look at this and just kind of see where we're sitting here. And I got the fib nodes just put in here. Let's just widen this out so that you can see. I thought initially we were setting up for another divergence here, but with this last gas move up since beginning of November, right? The entire month of November, it has been very strong. All right. We're probably going to run sideways for a bit until we get this tax package done, which will be the end of Dece. So we could be a little bit choppy in the month of Dece, more so than the normal. Now, remember, the normal average was for the markets to move up 2.5%, right? So if we were to take how we came into the month, in the month of October, right? So if we were to look at the beginning of October, which is right, the beginning of December, which is right in this area here, right? So the open in December was 2640, and we were to multiply that by 2.5%. All right, that would on average, so 1.025 times 2640 gives us 2706. So let's just call it round numbers 2700. So the mean of the market move for December would put us right at the 2700 area, which to me makes sense. If they get that tax package through, that would be there. Now, I would be willing to take some shorts just as a counter trend move to come back down and test some of these fib nodes down below. But that's kind of what we're looking at on just the mean, the average of the move. It can be a little bit less, it can be a little bit more, we may even go sideways. But that just shows you the potential projection here around 2700 based on the momentum that we're carrying. And if we look at the transports, look at the Dow transports, folks. Through the roof. Same thing through the month of November, up to new highs. We hit my major resistance point here, and we've held up above it. In fact, it may act as support, so that bodes well as we go into the end of the month or into the end of the year. And if we look at the Russell on a daily chart, right, you can see here we made new highs in the Russell. We had this little degradation down here, boom, and then up we go right here to the new highs. Right up here at 1553.90. So we're setting up for potential bearish divergence here should it move down a little bit. You can see this huge crazy move that we had on Friday. And the market buyers just stepped right in gladly. You can see that long tail down here. Came right down to about the 50 EMA and then came right back up again. That's a bullish sign, guys. I don't know how else to interpret that, but a bullish sign. We're setting up for a bearish divergence, but that doesn't mean it's going to happen. I think we're going to expect the momentum to slow down a little bit from what we had in November. November was a huge strong up month, but the momentum nonetheless is still to the upside. Okay, so I think that is still very strong. And then, of course, if we come down and look at treasuries, it had a very interesting day with that scare. Treasuries sold off and then went way, I mean, it moved almost 4 or 5 handles in one day. And then we kind of close here. I do believe that treasuries are going to be moving a little bit lower. As a realization comes in that, yeah, the tax package is going to go through. Infrastructure spending has probably got a high likelihood that probably get more Democrats on board with that. So it'll be more of a nonpartisan issue, unlike the tax plan. With more money coming into the U.S., and we're going to see, basically, we're going to see probably more companies move higher, and we're going to see the debt market move lower, which means interest rates a little bit higher, right? And there's some infrastructure plays that our members we're going to be talking about this Sunday, tomorrow night as well, should this stuff go through. So that's kind of what I'm seeing here. And then let's not forget that if we look at the oil, or before we get into oil, if we look at the other commodity, gold, you're seeing gold here is doing just what I said it would do. I mean, it is to the T, right? I said that I doubt it's going to take out the 1300 EMA. And of course it didn't, and it's rolling back over. Remember, gold hates low inflation and higher interest rates, which those are the two things that tend to just annoy gold, because there has no value in gold other than what people put on it. Much like Bitcoin, it's a storage of wealth or a hedge against fear, against higher inflation. But now look at it here. The 200 EMA has held it up very nicely. Should the 200 EMA break, you'll see gold come down to the 1250 area very quickly, because gold tends to trade the technicals like silver very well. And it's just got a huge amount of buying and selling going here. So right now it's range bound. It will break out up or down. It will either break 1300 or around this 1265 area, one or the other. So it's been in this tight range for a while. I think the odds favor a break to the downside near term. I do believe, but when we end 2018, gold is going to be much higher than where it is now. But we'll get into that much later. And then, of course, if we look at oil, oil is doing and playing out exactly the way I've been calling this. Now, for those members in our group, you've had the luxury of following us in an oil-only portfolio or a commodity-only portfolio that we've been trading. We're 21 for 21, guys. Doesn't get any better than that. It's better than what I would have thought. Generally, you want to get 8 out of 10 right, maybe 7 out of 10 if you have a couple of missteps, but you manage your risk and you end up doing net very well. We haven't had a loss yet. And we started doing this, by the way, back in November of 2016, way back over here. So we've withstood these big moves up and then the trend line and these big moves down and now these big moves up in this entire case, right? And let me just move it. From what you see on the screen right here, this movement, we've been successful 21 out of 21 times, okay? And for those of you that want to take advantage of that, if you get into our user group and our secret trader portfolio, we're going to be trading a number of portfolios starting in 2018. We're going to be trading a commodity portfolio, different sizes. We're going to be trading a futures portfolio only, a directionally based portfolio, and then we're going to be trading an equity portfolio. One for portfolio margin versus non-portfolio margin. So those of you that want to follow along, it's excellent. We've had a good 2017. I think 2018 is going to offer up a lot more surprises than 2017. 2017, even a rat brain could have done well if you just opened the paper at the beginning of the year and picked, 3 or 4 of the top performing stocks in each sector. You would have done well by the end of the year. That didn't take a lot of rocket science to do. I think 2018 is going to be a little bit different. But we're gonna play it not only in the commodity space but also in the equity space, and I think it's going to work out very well. We've got some currencies that I think are going to be offer up some great opportunities as well for this year. All right, normally I would go through agriculture and the meats and the softs, but that's kind of I stick those in with for our members when there are opportunities that come up. Outside of that, guys, it's just it's just a reminder. Make sure that you jump on that option masters because the discount is going away by next week. It's only going to last probably in the middle of next week. I would take advantage of it. There's going to be hundreds of videos out there for you to I guarantee you're going to find something that you weren't aware of that you can learn from. Okay. Otherwise, the price is probably going to double here shortly. Have a great weekend, everybody. Some great college football on this weekend. A lot of really cool things happening. Members, I will see you this Sunday night. Otherwise, everybody take care. Ciao.